Hey everyone, and welcome back to the channel. Today we're diving deep into an economic earthquake that is silently rocking the global financial system. We're talking about Japan, the world's third largest economy, and specifically, the absolute chaos unfolding in its gargantuan government bond market. It's a situation so volatile, so precarious, that some top analysts are calling it a slow-motion implosion. And trust me, when Japan catches a cold, the rest of the world, especially the US and Europe, is about to get pneumonia. For decades, Japan has been the poster child for low inflation, low interest rates, and frankly, unimaginable debt levels. But they managed it. They managed it through a policy framework centered around their central bank, the Bank of Japan, or BOJ. The BOJ essentially became the market, scooping up bonds to keep yields glued near zero, sometimes even negative. This strategy was called yield curve control, or YCC, and it was their economic holy grail. But that holy grail is shattering right now, and the shrapnel is flying everywhere. The shocking reality is that Japan's debt is now equivalent to about 260% of its GDP. That is the highest ratio among developed nations by a huge margin. For years, the BOJ's massive bond-buying spree kept the yields artificially depressed, meaning the government could borrow money essentially for free. But here's the catch. The global inflation wave that started post-pandemic finally hit Japan. People are now demanding higher returns for holding Japanese debt, pushing yields up. The BOJ is caught in an impossible trap. They've been frantically trying to defend the ceiling they set on their 10-year government bond yields, currently around 1%. To do this, they have to buy unlimited amounts of bonds. When a central bank creates money out of thin air to buy its own government's debt, it's not only incredibly inflationary, but it signals panic. They are hemorrhaging money, and the market knows it. Think of the BOJ not as a buyer of last resort, but as the only buyer. They now own over half of all outstanding Japanese government bonds. When you own that much, you've essentially nationalized the market. But the moment global yields rise, like when the US Federal Reserve hikes rates, investors dump their low-yielding Japanese bonds, forcing the BOJ to intervene even harder just to maintain their credibility. This bond market crisis isn't just about spreadsheets and abstract numbers. It's about capital flow and the sheer scale of Japan's wealth. Japan is the world's largest creditor nation. They own trillions in foreign assets, including massive holdings of US treasuries and European bonds. Historically, low rates at home encouraged Japanese institutional investors, pension funds, insurance companies, banks, to ship capital overseas in search of better returns. This outflow has been a critical stabilizing force for US and European bond markets. Now, as the JGB yields finally start climbing, the incentive structure completely flips. Why take the risk overseas when you can get a decent, slightly higher return at home? Japanese institutions are starting what analysts call repatriation. They are pulling their money back from New York, London, and Frankfurt to invest it back into newly attractive Japanese assets. And this is the global shockwave. When Japanese investors sell off vast amounts of US treasuries, it floods the American bond market, driving US interest rates higher and weakening the dollar's stability. For the US economy, which relies heavily on international buyers for its debt, this is devastating. Higher US rates mean higher mortgage payments, higher corporate borrowing costs, and a much greater risk of recession. It's the tightening of financial conditions, driven not by the Fed, but by Tokyo. The impact on currency markets is equally dramatic. The yen is under intense pressure because the BOJ is still operating loose monetary policy while everyone else is tightening. A weaker yen makes Japanese imports more expensive, fueling domestic inflation, which, in turn, pressures the BOJ even more to ditch YCC. So, what are the potential fallout scenarios? Scenario number 1. The BOJ completely caves and formally abandons yield curve control. If they do this abruptly, yields will spike dramatically, potentially causing massive losses for Japanese banks and triggering a deep domestic recession. Interest payments on their gargantuan debt pile would skyrocket, making the debt unsustainable almost overnight. Scenario number 2. They try to slowly phase out YCC, perhaps by widening the trading band incrementally. This might look calmer, but the market might interpret it as a sign of weakness, accelerating the sell-off and achieving the same result, only delayed. The key danger here is a phenomenon called the widowmaker trade. For years, professional traders have tried to bet against the BOJ, assuming YCC would fail. They always lost. But now it feels different. The pressure from global inflation and rising rates is too immense. The BOJ's attempts to defend the cap are now merely delaying the inevitable, and the cost of defense, in terms of market function and credibility, is escalating every single day. Look at the warning signs. The liquidity in the JGB market is drying up. When a central bank buys up all the supply, no one else is left to trade. This lack of liquidity means even small trading actions can cause massive price swings, making the market dysfunctional. This dysfunction ripples outward, destabilizing capital markets everywhere, because everyone depends on the stability of core developed sovereign debt. This crisis in Japan isn't just a domestic issue, it's a global stress test. If the world's largest creditor nation and the holder of the highest debt-to-GDP ratio loses control of its borrowing costs, it challenges the very assumptions underlying modern finance, that major governments can borrow indefinitely without consequence. The collapse of the BOJ's control over their bond market could force a sudden, painful repricing of risk across all asset classes, from US bonds to global equities. We are watching a debt paradigm shift happening in real time. The consequences of this bond shock will define the economic landscape for the next decade. If you thought inflation was bad now, wait until the world's biggest creditors start demanding truly market-based returns. Stay tuned, because we will be tracking this seismic shift closely. If you found this explanation helpful, please hit that like button, subscribe for more deep dives, and let me know in the comments. Do you think the BOJ can hold the line, or is a full debt implosion imminent? Thanks for watching.